Today we're diving into an increasingly common but often misunderstood part of compensation, restricted stock units or RSUs. We'll cover what RSUs are, why companies issue them, how they're taxed, the benefits and drawbacks, and how you should incorporate them into your financial plan. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What are RSUs? Restricted stock units, or RSUs, are a type of employee compensation. They are essentially a promise from your employer. You'll receive company shares or cash that's value is based upon the value of the shares, but only after meeting certain conditions like time served or performance targets. At the time they're granted, RSUs have no real monetary value, but once they vest, they convert into actual company shares or cash that you fully own. Now, why do companies offer RSUs? To attract and retain talent, RSUs reward loyalty and encourage employees to stay longer. Align interests. Employees with ownership tend to think like owners, focusing on company success. Reward performance. Some RSUs are tied to company milestones or performance goals. In short, RSUs are a tool to build a stronger, more engaged workforce while sharing the company's success. How are RSUs taxed? Now let's dive deeper into RSU taxation, because this is where things get important and sometimes complicated. In Canada, RSUs are normally structured to be taxed on vesting and are paid out as shares. When your RSUs vest, the fair market value of the share is counted as employment income. Employment income at vesting. The full value of the RSUs at vesting is taxed at your personal marginal income tax rate, just like your salary or bonus. Tax withholding. Your employer typically withholds taxes when RSUs vest. However, this withholding may not be enough if your overall income places you in a higher tax bracket. You might owe more at year end. For example, you receive 100 RSUs that vest when your company's share price is $50. 100 shares times $50 equals $5,000 taxable as employment income. This $5,000 appears on your T4 and is taxed like regular income. It's important to note, you owe tax whether or not you sell the shares immediately. But there's another key piece, taxation when you sell the shares. Capital gains tax. If the shares increase in value after vesting and you later sell, the gain is treated as a capital gain. Only 50% of the capital gain is taxable in Canada. So to continue the example, if you later sell your shares at $70 per share, 100 shares times $70 equals $7,000. Your cost base was $5,000, the fair market value when they vest, resulting in a capital gain of $2,000. Since only 50% of the capital gains are taxable, $1,000 is added to your taxable income. If the stock price drops and you sell for less than $50, you can claim a capital loss to offset other gains. However, you cannot use this capital loss to offset your income from when the RSUs become vested. Key RSU tax planning tips to remember. Prepare for additional taxes at vesting, even if your employer withholds some. Track your adjusted cost base carefully. It's the fair market value at vesting. Diversify. Don't let too much of your portfolio ride on your employer's stock. Work with a tax professional if you have large or complex grants or cross-border tax considerations. Benefits and drawbacks of RSUs. Now let's look at some advantages and disadvantages of RSUs. Benefits include a valuable component of total compensation, aligns with employee and company interests. Some of the drawbacks: taxable event at vesting, even if you don't sell. Risk of stock price decline after vesting. Potential overconcentration in single company stock. So, how should you handle RSUs within your financial plan? Incorporate them thoughtfully. Align RSU vesting dates and potential sales with your broader financial goals, whether that's retirement, buying a home, or investing for growth. Plan liquidity ahead of time for tax payments and RSU vesting. Regularly review and rebalance your portfolio to manage concentration risk. And most importantly, work with a tax professional and wealth advisor. A financial professional can help you maximize after-tax returns, optimize when and how much to sell, align RSUs with your full financial strategy, because when managed wisely, RSUs can be a powerful building block in your long-term wealth plan.